Hey guys, and welcome to this channel. And the topic of today's video will be market makers, what they are, and what is their job. And I would like to start this video from the very common mistake. I know that lots of people actually think that the job of market makers is to liquidate all the people, especially those who absolutely love trading with a hundreds leverage. But that is just a consequence of their actual job. So at first, what are these scary market makers? Market makers are actually huge companies or other huge players who have actually lots of money, and they can manipulate the price of various assets, especially those where liquidity is low. And by the way, one of the main jobs of market maker is to provide liquidity for huge capitals. Because, for example, if there is the liquidity of an asset may be $100 million, but there is a player who wants to buy an asset for $200 million, then he just doesn't have enough liquidity to make a purchase. Or if that person will actually buy on the market price for all $200 million, you can imagine what will happen with the price at that moment. It will just go to the moon straight away. One huge candle and everyone will be liquidated. But actually, one of the consequences of the job of a market maker is to liquidate people as well. How it works. So let's, by the way guys, there is one general rule which works on any market. It doesn't matter if it's a market of real estate, if it's a cryptocurrency, stock market, whatever. The main thing is that the price of any asset, absolutely any asset, goes to the level of liquidity. For example, if there is more liquidity above the current price, then the price will go there. If there is more liquidity below the current price, the price will plummet. That's the way markets work. Because the main feature of any asset is its liquidity. If there is no liquidity, then it's not interesting to most of the players, because everyone wants a liquidity in order to buy assets for as much money as they have. So I know that my speech might be a little bit confusing for now, so let's move on to the examples. So I've just opened Bitcoin chart. By the way guys, a quick remark about Bitcoin price for now. We're still in this range from $26,300 up to $31,000. And while we're in this range, we're still in this tremendous consolidation, which already lasts for how long? For 75 days. Guys, I can't believe it. We've been in this corridor for 75 days in a row. Actually, I can't remember the time on Bitcoin when it just stagnated for such a long period of time. That's the first time when I see that. So, and do not forget about all the short positions on S&P 500 that I discussed in one of the previous videos. If you haven't watched them, you can find them on my channel, and I really recommend you to watch that videos because they'll definitely improve your understanding of financial markets And this knowledge might help you to make better decisions if you're one of the players in this huge game. So, and for now, I've just made a quick review of Bitcoin price, and we can move on to the liquidity and market makers. So, we can just look at this example. For now, there is a small local consolidation, which means that for now, players exchange their assets and money. Some of them sell, some of them buy. There are players who suppose that the price might just reject from this level and fly to the moon. The other, maybe even half of all the players, suppose that the price will go in the opposite direction and it will go straight to $24,000. Of course, nobody knows exactly where the price goes and where it will go in the future. That's why there are almost 50-50 ratio, at least for now, I suppose, because we're still in this consolidation. But there are players who are opening short positions and they put their stops here, for example. Like maybe here, at that stupid level, for example. That might be a reasonable one. Then there are players who put their stops here. Maybe some of them even put here. And of course, there is a great number of people who suppose that the price will go to the moon straight away. And they open long positions. Where do they put stops? For example, some of them put here, maybe here, some of them here, and maybe there are some players who even put them here, on this level. Okay, for now, what do we have? We have two kinds of players. The first half of the players is short players. The second half is long players. One of them might be right or wrong, or maybe both of them will be wrong because market maker will actually liquidate at first short positions, then squeeze all long positions. Who knows? It also happens, and I'll be able to show you some examples as well. So, but let's finish with this example. So, for now, we have the price here, and we have both long players and short players. Then, it's just a matter of time when there will be more short positions or long positions. For example, let's imagine that there is a really negative, too much negative information, that all the markets will collapse, that the economy of United States is a piece of shit and it will definitely plummet, and everybody opens short positions. Okay, for now we have lots of short positions. Here, we have stops here. There's lots of players who just open random short positions. Then, what does it mean? It means that all these players, if the price actually plummets, all of them will earn money. But who will be paying for this party? Actually, market makers in this case. If the price will go down, market maker will be one who will be paying for this party, because all these people want to earn money, and we can liquidate only those who opened long positions. That is why it's just unreasonable, because there is not enough money to satisfy all these limit orders, all these opened short positions. But in the opposite direction, if the price just skyrockets, we'll get massive cascade of liquidations, and then all the players who open long positions will win. That's actually how markets work. The majority must to lose in order for minority to win. That's the rule of money. Because if you play otherwise, there will be not enough money to satisfy the majority. If you liquidate the minority, the majority won't earn. And if you're earning money, that means that somebody loses money. That is why when we see the situation when there are lots of short positions but only few long positions, the price will definitely go up and liquidate all these people. I don't know what I'm doing here, but the price will go here to liquidate all these people and to satisfy the orders of people who opened long positions. So all the shorts will get liquidated. And the point is that market maker actually sees all these limit orders and it thinks, aha, okay, if I just put a limit order and buy lots of units of this particular asset, I'll raise the price. And then the price will rise automatically because of cascade of liquidation. So the people here will be liquidating the people above them, and that people will be liquidating further and further. Why is it so? Because, for example, we liquidate the first person here. What is short liquidation? I have already told you in the previous videos. The liquidation of short is purchase. What is purchase? Purchase leads to increase in price. If the price increases, then there are more and more limit orders, more and more liquidations called. Lots of margin calls leads to the price skyrocketing. That's actually what happens, what we saw here. What does it mean? What does this green bars mean? Almost vertical raise. It means that there were so many shorts that market maker only raised price for maybe $1,000, and then there was a huge cascade of short liquidations. Market maker just sold here his assets. Because why? It just spent several million bucks to raise the price $1,000. Then there was a cascade of liquidations and the price is already here. And it can sell its assets to liquidate other short positions. That's great. That's actually how market makers work. And their point is not to liquidate you, but to earn money as well, by providing liquidity to the market. If all these people sell, then market maker has to buy. If everyone buys, market maker has to sell to satisfy the demand and to regulate that balance between supply and demand. That's actually the job of a market maker. And the same actually works in the opposite direction. I've just spent a great amount of time explaining you this situation. In the opposite, it works the same. So if there are too many long positions and too few short positions, then the price goes down to liquidate all the long positions. And what is the liquidation of long? Of course, it's just selling. Sales actually lead to price plummeting further and further. That's the way markets work, and that's the way market makers work on the market. So I hope that that explanation was clear to you. If you still have some questions, you can write them in the comments below, and maybe in the future I'll consider recording one more video to explain this information in a better way, and maybe we'll be able to see some more examples. So I have already showed you this example with long liquidations, and in the very latest video I also showed you the correlation between the amounts of short and long positions. If you haven't watched that video, it's a really good idea to do that, because you'll definitely find lots of useful information there. So guys, if you find that video useful for you, that it help you to understand financial markets better, then subscribe to this channel, give this video a like or dislike if you didn't like that video for any reason, and I'll see you in the next one. So, bye.